Ladies and gentlemen, my name's Jesse Vergally, and today we're talking about an area of real estate I get asked about probably the most, and that's the capitalization rate, aka the cap rate. Here we go. All right, so the cap rate is something you hear about all the time when it comes to real estate investing. You know, is that a 3 cap? Is that a 5 cap? What's the yield on that? What's the return? So I'm gonna try to break it down as simply as possible. The cap rate is the logical relationship between the value of a property and the income it produces. That's it. That's what it actually is. Now, mathematically, we look at that as, one way to look at it is the cap rate is equal to the net operating income, the NOI, divided by the value, or you can call that the price. So this seems simple enough, but oftentimes I think we get bogged down in how some of these terms are used. Now, before we get into this, one major assumption that is used when using the cap rate is that you're not talking about the debt or financing structure. You're just looking at the property. Because other people will have different financing structures, 0 money down, 5% down, 30% down, that is all being put aside because we're looking at it as a comparable tool, and it's best used as a comparable tool to look at different assets that are similar in a similar area. That's really the best use of the cap rate. Looking into this, what we will see is that the actual cap rate, as shown here, is the net operating income divided by the value. The net operating income here, I feel, is the one that people get bogged down or confused about the most. And really what that is the gross operating income of a property, okay, minus all of, let's call it the ops operating expenditures, the expenses. Now in this fancy box here, these are all the subtractions that you would subtract from your gross operating income of the property or the rent of the property. You'd have management expenses, insurance expenses, property taxes, et cetera, et cetera, et cetera, and that would go down to produce your net operating income. So let's make an assumption here. Let's say that the gross operating income is $100,000. Okay, so you're making $100,000 in this property, and let's say that all of the operating expenditures equal $50,000. Okay, so those are all your expenses. 100,000 minus 50,000, we have $50,000 in net operating income. Now, one thing to keep in mind here for all you fancy finance and accounting cats out there is that NOI is very similar to an accounting term called EBITDA, earnings before interest, taxes, depreciation, and amortization. And the reason I bring that up is that like NOI, EBITDA does not account for, like we were just talking about, the financing structure, because the actual debt service, the mortgage payments, those would all happen here, what we call below the line. And we're leaving those aside, as I said, because we're looking at the cap rate, and to get to the cap rate now, we can put this into our equation. Cap rate equals, as we said, net operating income, which we now know, $50,000 divided by, let's say this property is being sold for $1 million. Now, for you savvy guys out there and gals, 50,000 divided by a million, we get 5% cap rate, or 0.05 as a decimal. People often say, ultimately, what is the use of the cap rate? And what is a good cap rate? Well, I mean, if you're an agent, you're gonna have one cap rate when you're selling a property. When you're a purchaser, you're gonna think about a different cap rate when buying a property. If you're looking at cap rates as a fundamental comparison tool, if you see a property that has a 5% cap rate and you see another property in that area that the building is just as good and they're almost as identical as you can get, and one has a higher cap rate, it might tell you that the one with the higher cap rate is a better investment. However, just because a cap rate is higher does not make it better. So for instance, real world, let's say New York City cap rates, 3%, like they're low, okay? Let's go to Buffalo. Love Buffalo, don't have anything against anybody from Buffalo, but what I do know is their cap rates are not low, they're high, 13%. If you don't know anything about cap rates and you're just looking at the two, okay, the one at 13% must be better, because for that example we had before of $1 million, that would mean you're getting $130,000 of NOI. That must be a better example or a better cap rate. However, the reality is that there is a risk component to cap rates. And what the Buffalo cap rate is telling us is that for investors to invest in Buffalo, they have to be compensated. They have to be incentivized by a much higher return for them to put their money into Buffalo. And that's where you're seeing this high 13%. So it's not to say you can just look at two cap rates and know one is better than the other. You have to look at comparable properties in comparable areas. And they're just one input into a host of different things you can utilize to look at the value of a property. If you do have an area and you're trying to figure out what the value is of a property, you can look at comparable sales, and you look at what those comparable sales had in cap rates, right? Their NOI divided by their value. And say you get 10 of them and you average those 10 and it happens to be 4%. All of a sudden, you can now start using that 4% to figure out what the value is of these other properties. And how do you do that? Well, if you look at what we had before, if cap rate equals NOI over value, then value just mathematically equals NOI over cap rate. So if you have the cap rate, if you have whatever, let's say it's a value equals NOI, and you have a 4% cap rate, you can look at what income a certain property that you're looking at is producing and divide it by the cap rate that you're finding in comparable sales in that area to produce a valuation. And then you could start to see if the list price is matching up with your valuation. Now, as I mentioned before, this is to be used with other tools, cash on cash return, discounted cash flow. We have done other videos to kind of go over different ways that you can look at the appraisal or the valuation of a property. But this is just one tool in your tool belt. Now, another cool trick when it comes to cap rates is that for any cap rate that you have, you can do something cool where you take one, divide it by the cap rate. So let's say the cap rate's 5%. 0.05 as a decimal, that equals 20. And some of you probably already know where I'm going with this. What this basically is an earnings multiple. So we're basically saying for $1 of earning, $1 of net operating income, we get $20 of value. So that's kind of a fun little trick that you can do with any cap rate. 1 divided by the cap rate, figure out the actual earnings multiple. Lastly, I will say cap rates go down, value goes up. Cap rate goes up, value goes down. This is what's called an inverse correlation. They are inversely correlated. And this is important because when you're seeing a trend in an area of cap rates going down and down and down over time, something called cap rate compression, like in New York, like in California, what that means is that values are going up, up, and up. And that means potentially a market is overheating. Something to keep in mind when you're looking at market trends and you're trying to utilize cap rates to see that. I hope that's been helpful. Let's just go over that again. What is a cap rate? A cap rate is the relationship, the logical relationship between a property's value and the income that it produces. We make the assumption that you're buying the property with all cash. The best way to use a cap rate is a comparative tool in addition to other tools that you would use in valuation. That's it for me. My name's Jesse Vergali. I hope that was helpful. If you liked this video, hit the like button. If you disliked it, hit the dislike, but tell me what we can do to improve. If you have any questions related to this video, or if you want us to do any other videos in the future, again, leave them in the comments below. If you're not subscribed, I don't know what you're doing, hit that subscribe button. Anyways, that's it for me. It's been a slice. We'll see you next week.